Welcome to HPK Provident Advisors Friday Live. This is Halloween, Friday, October 31st, 2025, and we've got everybody here today. So, as you know, for the folks that have tuned in with us before, every Friday on Facebook, 12:30 p.m. Eastern Standard Time, 1, 2, or all three, like today, the partners of HPK Provident Advisors jump on to Facebook, talk a little bit about the markets, talk a little bit about financial planning, cover any questions that we get during the week, any cases that we're working on. And for those of you that follow us, what we do is during the week, we put out social media posts. Mike puts out a market, the week ahead in the markets and kind of a summary of the prior week. And then each of the other days on Facebook, on LinkedIn, on what else do we have? Instagram. Just ideas, things for you to think about, and some of our observations on how we're helping folks implement these different ideas. But as I mentioned, I got Michael Kutch here. Mike is our portfolio manager at HPK Provident Advisors, and David Harper, one of the other financial planners. David and Mike are in Florida. I'm in Western Pennsylvania. And, well, we've had a lot going on. I'm going to kick it off by... I mentioned it last week, and hopefully we'll get some updates from the man himself. But Mike is now married, got married last week, last Wednesday it is. How's it feel, Mike? Anything different? Do you feel different? You don't look different, I got to tell you. You do have a glow about you.
No, I feel about the same, but very excited for our future. And it was we did a cruise wedding. It was a great week. A lot of cool events. A lot of family and friends came. Ceremony was beautiful. And of course, my bride was beautiful. And it was a really cool experience. We got married by the captain. And then afterwards, he brought us up to the ship bridge. And we got to sit in the captain's chair and steer the boat and honk the horn. So it was really cool.
Corinne, let me rephrase. Corinne was the one in the captain's chair. Is that right?
Well, yeah.
Obviously.
That's just the way it goes.
Yeah, and then we got a bunch of cabanas at the Royal Caribbean Private Island Coco Cay. So that was really cool. There was all these there's water slides coming off of each of the cabanas. So just a cool experience.
With a 5-foot lemon shark. He was obviously well fed. He didn't need me.
I didn't hear anything about the shark. Interesting.
Yeah. And it's a little sombering, Mike. We had like 3-4 days on the boat with all that scrumptious food. Either a good thing or a bad thing, but I didn't need the flotation devices. When I was in the water, I was floating au natural. I didn't need the flotation devices. Maybe that's not such a good thing.
Well, Mike, congratulations again to you and Corinne. That is certainly exciting stuff. And thanks for sharing the picture. I did share one picture last Friday of you guys right after the ceremony, and it looked fantastic. So congrats again to you.
Thank you.
Yeah. Well, let's talk about, should we cover the markets a little bit?
All right.
Let's jump right into that. We didn't get a Mike update last week, so catch us up on what's happening.
Yeah, so despite the market's not really getting any real economic data right now, there's a lot going on this week. We had government shutdown is approaching the previous high, which was 35 days. We are currently at 31 days. I don't know, not much progress, but I know the Republicans are threatening the food stamps being paused starting November. So that could bring Democrats to the table a little quicker. So hopefully that gets moving. All the federal employees haven't been getting paid for the most part. I know we posted something today about delays with airports with TSA and all that. So we're starting to see some effects, and every week this goes on, it's going to cause more and more economic pain. They estimate it's going to take about a tenth off of GDP each week it goes on. And then those workers will get paid eventually, but I'm sure they're not spending right now. So you're going to start to see effects of that. But market doesn't really seem to care too much. We had a down day yesterday, but we're pretty close to all-time highs. Now the equal weight has seen a little more damage under the surface. Breadth hasn't been that great. Regardless, earnings have been really good. I think for Q3, it's tracking about 10.5%. We had a bunch of the Mag 7 names report this week, and overall, pretty good results. Mixed reactions. Google had a very good surprise to the upside. Microsoft, not so much. Meta, very bad. Meta was mainly due to one-time special tax they had to pay, and just estimates or expectations are so high on those names. It's tough for them. But today we're bouncing back a little bit. We had a Fed meeting earlier in the week. As expected, we got a 25 basis point cut. There was one member that dissented and was in favor of no cuts. And then the new guy wanted another 50 basis point cut again. Reading the commentary after the meeting, there was one other member that did vote for the cut, but said he would have preferred not to do it. So Powell talked about December being more of an open meeting. Markets pricing in another 25 basis point cut, but it seemed like that's not a sure thing at this point. What really changed in the prediction markets is so they were thinking 4 cuts were going to happen next year. That was like a 60% chance. That dropped significantly. So the market's not really too confident we're going to get all those cuts. So the other note in the Fed meeting was one, downside risk to the labor market, which we've been seeing. But as with the government shutdown, we're not getting a lot of labor market data right now. So we're kind of flying blind. And then the other thing is they're going to stop quantitative tightening in, I think, starting December 1st. So that's a good thing. Maybe ease the fixed income market a little bit. But we're still kind of in the camp that a pullback would be healthy and probably need it. We're trading at 22.8 times 2026 earnings. So very pricey, and market's getting a little euphoric. A lot of risks out there that they don't really seem to care about.
Mike, I talked to several folks this week, and some of the people that we work with have been taking a wait and see approach, which has worked out pretty well because you get decent interest rates, decent yields on money markets and CDs and things along those lines. And those yields are coming down.
They are.
And so the wait and see folks are saying, hey, geez, I'm not getting paid as much to wait, but yet I still think there might be a better opportunity, a pullback in the market where we might have a chance to buy things that we really like at prices less than what they are. So we're in kind of an interesting phase here, looking for different places for yields for parking spots, and they're coming down. But to your point, there could be, we don't know, we can't predict the future, but there's the possibility in the not too distant future that there's a better chance to get some of those. And this is long-term money. Most of these folks are talking about to say, hey, I'm going to park this for a while, but I just don't think this is the best time to jump right in. So I'm going to sit and wait, get some interest, and that interest is coming down. Still some decent rates out there, but it would be nice. It could be nice, could potentially nice to get a little breather, a little pullback in the market, get us that entry point for long-term money. Of course, short-term money, you need money in a year, 1 or 2 years, then it is what it is. You park it someplace relatively safe, pick up the yield, which is coming down, and that's okay, because from a planning perspective, you need that 1 or 2 years, then you're going to need it to be available.
Yeah, we will get a correction at some point, but right now, dip buyers are in full force. We get a 2% drawdown, and we march right back up.
Yeah. I have a couple of points. One with Mike was saying a lot of these companies are coming up with better than expected profits. And one of the things that sort of caught my eye is that they're expecting higher tariffs. And now with some of these deals, the tariffs are not as much. And so the companies have figured in a higher tariff. Now that the tariffs have been negotiated lower, that's a boon. And so they're seeing some of their profit as a result.
Yeah, I didn't even mention the trade deals going on.
Whew.
China and the U.S. agreed to a 1-year pause. The components of that were the U.S. is going to reduce the fentanyl related tariffs by 10%. So that brings the overall import rate from China to about 45%. And then in exchange, they're going to ease the rare earth limitation.
No. Right.
Yep.
Which
And
is huge.
soybeans.
Mm-hmm.
Purchase soybeans from the U.S. farmers, which they have been holding off on. The other thing I wanted to say to your point, Brian, about the yields, we are at near all-time market highs. There's not really that many. The rates for money markets are going to go down, especially with the Fed cutting rates and so forth. But we have seen, I think, probably it hasn't been since the early 2000s that I've seen some yields on some annuities. There's some annuities that are paying out 9%. Okay, that's high. Thank you, Mike. And not everyone should be in annuities. We get that. We know that. We will never be accused of overselling annuities. We will never be accused of that. Okay, and that's going to be a podcast that we will do later. Okay, we'll go into a deeper dive on that. But just understand that there are some options for yield that's not just in money markets. And give us a call, and we can discuss those, whether those would be appropriate for you or not.
Yeah, and that fits into one of the posts I put out on now Tuesday. We put out the 2026 tax brackets that came out of OB3, the one big beautiful bill signed in July of this year. So we put that out as kind of an update, and then on Thursday we did talk a little bit about the new standard deductions. We had covered previously the added standard deduction for those over the age of 65 is $60,000, but this week was just the standard deduction. So Tuesday was tax brackets. Thursday was the standard deduction update for 2026. But, all of this kind of fits into what I put out on Tuesday. It's an ongoing series, in my opinion, our opinion, about how financial planning is more about time than it is about money. Of course, it involves both of those concepts. Your two most limited resources, time and money. Most limited, most important being time. And this week's post was about the investing side, the investing aspect of financial planning, and how really the investing is the longer time you give yourself for a goal, the more opportunity that money has to either get more yield, higher interest rate, potentially more return. And so the investing side of financial planning really is about your time frames. And time frames, like I had talked about a little bit earlier, if you have a time frame for a portion of your money that is 1 year or 2 years, then you really can't have a high expectation that there's going to be a huge return on that, because you're going to look for safety and less return. However, for portions of your money that have more time, yesterday's trade deal in 20 years won't be as important. Will it have ripple effects over 20 years? Somebody can make that argument. But for the average individual, when they've got a 20-year time frame, they're not going to look at it and say, well, 20 years ago, I'm glad I got that money together because Trump and Xi Jinping put together a nice deal on soybeans. You're just not. And so when we look at the financial planning, we're looking at those time frames for different portions of your financial goals and for different portions of your allocation of your resources available, the money that's available. So again, reemphasizing that it's really more about the time than the money. And unfortunately, right now, kind of going back into the yield discussion and rates coming down with the Federal Reserve, we just have to be comfortable that shorter term money, 2 year and less, let's call that short term money, you're just not going to get as much as you did several years ago. And that's okay. That portion of your financial plan still is serving its purpose. It's not exciting. It's not as much interest as you would have gotten a couple of years ago in CDs and that kind of, but it's still serving its purpose. And that's why I like to say that, the financial planning is really more about time. And if you get these things right and you're comfortable in saying, hey, the interest rate on my 1 year money's coming down, that's okay. It is what it is. Then you'll spend less time worrying about it and searching for some unicorn of investment that's going to pay a huge yield for 1 year. So anyway, that was the Thursday post. I didn't mean to commandeer our Friday live, but figured I would summarize some of the.
It's good information. It's great information.
So we've got Halloween today, which is one of my favorite days of the year. What I've discovered about myself is I don't like to dress up. So for me, Halloween is really representative of my favorite time of the year, which is fall. So although I do love Halloween, as I've gotten older, I've realized that really Halloween is just a representation for what I love, which is the fall. Now, you guys down in Florida don't get it as much, but we've got we are past peak here in Western Pennsylvania. It has been a decent fall, but now it's getting kind of brownish and whatnot. And I don't think Florida guys are going to miss that much. It is. I do love seeing the little trick-or-treaters, though. The smiles on their faces, and they get all gussied up, and they've been, trying to decide what they're going to be for Halloween for a couple weeks now. And boy, do I just love to see that joy. And so that's really my favorite part. When I say I love Halloween, people, picture me dressing up, and I don't. That's not my thing. But I do love Halloween because I love to see the kids, and I love the fall. I don't know how that helps anybody in their financial planning, but it's a little insight.
It's all very scary. That's how it goes.
Well, there are some things that they're a little bit scary.
Are the grandchildren all dressing up, David?
Oh, yes, they are. And they dress up for school as well, for the daycare. Yesterday, our youngest grandson, Jay, went to preschool. And he was supposed to dress up. He's dressing up as Spider-Man. He would not put the Spider-Man costume on. Nope.
Classic. Can't go wrong.
Nope. But he had a wolf hat. And it was a wolf hat, even more than Daniel Boone ever had or Davy Crockett. And it wrapped around. And so he wore that wolf hat all day long. But don't tell him it's a wolf because he's convinced it's a bear. We have he has these two black wolf stuffed animals, but they're not wolves. They're bears. He loves bears.
It's beauty of childhood, unlimited imagination.
Amen.
Ryan, thanks for holding down the fort last week. If you could name
absolutely
the most interesting case you came across, if there is anything that stuck out, what would it be?
Oh yeah, most interesting I came across two of these last week, folks that had over contributed to their retirement plans and need to reverse some of that. One was a corporate plan, the other one was just an individual retirement account. So it's important to get those things done before the tax deadlines. If you find that you've accidentally over contributed, you can reverse those. Of course, we don't give tax or legal advice. These are my observations. These are things that I worked through last week. So it is possible. You want to try to be as mindful as you can and not over going beyond those limits. Of course, there are IRA limits. This year, the IRA is $7,000 under the age of 50. Over the age of 50, you get an extra $1,000. And then there are income limitations on whether you're doing Roth IRA or the deductibility of a traditional IRA. I won't go into those details, but you really kind of want to be conscious of not going over those. But if you do, it doesn't have to be a major deal. It gets a little more complicated in the corporate plans because you have your own this would be a 401k, 403b, 457, that type of thing. There is a limit on how much you can put in as an individual. And then if your company is matching, and then if you have another retirement plan at that job, there is a limit. When you add all of those things together, you can't go over that limit. And if you do, It's pretty high. Last year was 69,000. I believe it's 70,000 this year. That's between your contributions, your company match, and then if there is another type of retirement plan, for example, employee stock ownership plan or something like that. When you add all those things together, you don't want to go over that limit, and if you do, you got to start reversing things.
And I found it interesting that you mentioned yesterday that there's a deadline in any given year of, was it October 15th or?
Well, it's really again, we don't give tax or legal advice. You certainly want to work with a qualified tax preparer on these things. But yeah, it's really around the tax deadlines. April 15th, you want to do that. You file an extension. You got till October 15th, but you really want to get those things done before then. Otherwise, you can kind of run into penalties. It becomes harder to calculate if you've over contributed. How much that over contribution has earned, if it has earned anything, right? You can imagine if you over contribute to a plan and you have that invested and it's done well, and a lot of things have done well this year, you've got to kind of figure that out. That's called NIA, net income attributable. You got to calculate that and pull that out as well, because not only is it the contribution, the over contribution, but it could potentially be the growth on that, if there was growth on that over contribution. So it does get a little bit complicated, but that was the reference to the deadlines. You really want to get these things figured out and done before the tax deadline, April 15th, or on an extension, October 15th. So that was those are interesting. It's not as fun, but those things happen, and we're certainly willing to work with folks and try to figure out if that was the case. We don't see it often, but Mike, to your question, it was interesting, and it was kind of a very interesting week, and both came up in the same week. We don't see it often at all, and then twice in 1 week. Like, well, hey, how about this? That was the I wouldn't say that's the most fun, but it was the most interesting. So kind of worked through that, and yeah, that would be. It's one of those things that come across your desk and you're like, didn't have that on the calendar for today. Well, let's tackle this one. So, but that's all right. That's what makes, for me, certainly that's what makes our profession interesting. It's always different. Markets are always different. Individuals have different wants, needs, goals, wishes, and tax laws change, and it's a very, very dynamic, and that's what I enjoy the most. Is, you come across those things. I don't see it often, but let's jump right into this. So,
and we're wrapping up October now, so give everyone an RMD reminder. If your age they change it all the time these days. 73.
Yep. 73. Yeah. So if you reach the age of 73 this year, it's time. Required minimum distribution is the age when the IRS says you have to take some portion of money out of qualified plans. IRAs, 401ks, if you're still working, there's provision, so it gets even more complicated. But if you turn 73 this year, you really got to look and say, hey, how much do I need to take out? Now, these are individually owned IRAs. Beneficiary IRAs have different rules. But if you got your own IRA, your own 401k, 403b, 427 like that, and you've turned 73, you got to look into it. So yeah. And for the first year, if you turn 73 this year, you actually have until April 15th. That's only in the first year of your required minimum distribution. You could take it out by April 15th. Everybody else has to take it out if they're ongoing required minimum distributions, has to take it out by the end of the year. But in the first year, you take RMDs. We do not suggest that. We do not encourage that. Our default plan is let's go ahead and get your required amount out if it needs to come out and get taxed by December 31st. So it's 73 this year. For those folks born 1960 or later, it's the age of 75. So it is a moving target, Mike. Yeah, that's a great reminder. And, that's something we do our best to monitor throughout the year. And, like I said, the beneficiary IRAs are different. If somebody passed away prior to 2020, it's on one set of rules. Somebody passed away and handed you an IRA after 2020, different set of rules. So it gets complicated. But yes, that is an excellent reminder, Mike.
And then, David, you want to talk about your seminar that you're hosting this month?
Yes, sir.
Couple weeks.
I'm pretty pumped up about this. You realize that women were not even allowed to have a credit card in their name only until after 1974.
Really?
Yeah, I did not know that.
And in addition to that, they could not have a bank account in their name only. They had to have their father or their husband to be on the bank account. And that's not that long ago. And women got the right to vote in 1920 through an act of, a change to the an amendment to the U.S. Constitution. So it's a little strange because realize that women not only hold the purse strings to most of the family's finances, but they also do a whole lot of other things. So this is something just for the women. Happy hour to help their financial knowledge. The idea is that they fall into this fog syndrome, fear, obligation, and what's the G? Fear, obligation, and guilt. That too many of their finances are predicated on those things, trying to be the good wife, the good daughter, And I'm really happy to have with us, speaking of Dr. Frank Castle, a personal friend of mine, and he is an expert on Bertha Palmer. Bertha Palmer was a very progressive woman beyond her years. She lived in Sarasota from 1910 to 1918 and actually owned about 3/4 of what is now Sarasota County. And she was a phenomenal businesswoman because when she became a widow in 1901 or 1902, her husband, Potter Palmer, who had the Palmer Hotels there in Chicago, maybe you've seen them. So he left her with $4 million, which was quite a sum then. When she passed away, her wealth was estimated between 16 to 20 million. So she did something with that, and a lot of that had to do with a lot of phenomenal planning on her part. She was quite the independent woman, and we're looking forward to sharing a little bit of local history, which impacted the whole nation, as well as other things. And come November 12th in 2025 at Cooper's Hawk, and please sign up. Space is limited. We have 30 spots, and I encourage you to sign up quickly.
And just to clarify, that's the Cooper Hawk in Sarasota, out east on Fruitville.
Yes, if some of you in Western PA want to come down and hear about Bertha Palmer, get on a plane. Hopefully you get that you get there and come on down. I'll be more than happy to host you.
And you can actually find the registration for that directly on our website. And so this is hpkprovident.com. And if you go over to resources, you'll find the blog. I talked about some of the posts that we had put out. If you go to events, so HPK, this is our main page, resources and events. And so right there, you can find the registration link. You can register for yourself. And you can also register for others. If you're bringing more than 4 people, yourself and plus 3 others, go ahead and do an additional registration. This page will allow you to register up to 4 folks, but if you're bringing more than that, go ahead and do 2 registrations, and we'll interpret that and see that properly on our side. But that's hpkprovident.com. It's under resources and then events.
Love to see you there.
All right. Well, you guys have anything else you want to add before we flip?
Well, we've covered a lot, and we've gone a little bit longer than we normally do, which I think is fine because we covered some things. And would just like to emphasize, feel free to give us a call. Let me move this out here. You can find our information right here, hpkprovident.com. There is a contact us. link there. So you can send us an email. You can send us a question, an observation, or you can call the office directly. That, by the way, rings to the Western PA office and into Florida simultaneously. That number is 724-463-1331. So covered a lot. No, that's all I got. I got to go get the candy bowl ready.
And also remind people that we've been receiving emails about people that have contacted us, and we'll reach back to you through emails. But if you leave a phone number, you can hear from us a lot quicker. So when you get the contact, you say, hey, you have a question about something we've talked about or another question that we can help you with, you put a phone number there, and chances are you'll get a call the next day as opposed to an email that's going back and forth, which is fine. Either way, we do not sell our contacts. We do not share our contacts. It stays here with HPK Provident Advisors.
All righty. We'll be glad to help. All right, gentlemen, this has been good stuff. Have a great weekend. Happy Halloween. Be safe, everyone. Make sure there's a lot of lighting. Wear your trick-or-treating. It's good to have glow sticks on the kids' costumes and that kind of thing, or on your costume. And we will be back next Friday, which is, what does that bring us to November 6th, I guess. 12:30 p.m. Eastern Standard Time on Facebook. Feel free to send us any questions, thoughts, feelings, observations, whatever it might be, and we'll be glad to address those. All right, gents. Have a wonderful weekend. Everybody be safe.
Member FINRA and SIPC.org. Advisory services offered through LPL Financial, LLC, a registered investment advisor. Brian Peluso, Michael Kutch, and David Harper are registered representatives of LPL Financial, LLC. Content discussed is for informational purposes only and not intended as an offer or solicitation to buy or sell any security or investment strategy. Any opinions expressed are those of the authors and do not necessarily reflect the views of LPL Financial or its affiliates. All investments involve risk, including the possible loss of principal. This communication may include links or references to third-party websites. These links are provided as a convenience only. LPL Financial and its representatives are not responsible for the accuracy or content of such sites. Brian, Mike, and David and HPK Provident Advisors may only transact business in states where they are properly registered or exempt from registration.